Hello, good people, and welcome to Personal Credit Solutions. This is Darrell. Our YouTube channel is designed to provide credit education to our clients and to help them better understand the credit repair process. And today I want to talk about 6 things you should know about a good debt-to-credit ratio. It's an important topic. It's my second video. I have to deal with this a lot with clients, helping them understand how this works. So I want to go ahead and do another video, bring it to the front again. So as with many complex fields, a lot of jargon exists in the world of finance because, that's what complicated subjects need, right? A lot of mumbo jumbo that makes them even harder to understand. Making matters worse, some of those difficult terms are actually redundant. That means they mean the same thing as other terms. This not only makes it harder to figure out what you should know, but it can even make it challenging to determine what you already know. For instance, think of debt-to-credit ratio. This sometimes less than common term is actually referring to the same thing as your credit utilization ratio. So we want to make sure that we remember that utilization term. That is going to be something you'll see a lot when it comes to the debt-to-credit ratio, when it comes to financing with your creditors. They'll tell you about this kind of thing if it's a problem, which is an important part of your credit score. It's also a term that you may already be familiar with if you've spent some time learning about your credit. Though its multiple names may be confusing, your debt-to-credit ratio is both important to know, and fairly easy to understand. So in this article, we're going to talk about that. We'll examine the definition of debt-to-credit ratio, how to calculate it, how to improve the ratio, and look at a few credit accounts that may help you improve your credit utilization rate. So what is the first thing here? All right, let's take a look at the first one here. Your debt-to-credit ratio is a part of your credit score. So in the most basic terms, your debt-to-credit ratio or credit utilization ratio or balance to limit ratio is the amount of debt you currently have compared to the amount of credit you have available. I'd like to say that a little bit more simple. So it's the ratio between the balance on your credit card to the limit on your credit card. For example, if you have 3 credit cards with a balance of $100 and a credit limit of $1,000, you have $300, $100 on each card, right, in debt, and $3,000 in potential credit. So that would make your debt to credit ratio or your utilization rate 10%. So this is a very important part of your credit score. It comprises 30% of your credit score. So if you look at payment history, you have 35%, and your balances or your debt to credit ratio is 30%. That means these two alone are 65% of your score. So this is what you want to focus on when you're trying to increase your score. All right, so your credit utilization is also an important factor in your Vantage score, the other commonly used consumer credit score that you get for free, like Credit Karma and many of the other sites. So we don't like to really focus on that score too much. So let's just go to number 2. You can easily find your ratio with an online calculator. Now, I just did a video showing you how to use the mortgage calculator. I've got a video really going through the debt to credit ratio with a calculator. One of the best ways to figure out your debt to credit ratio is also a good way to keep an eye on your finances in general. So through a spreadsheet, that's a good way to do it. On your spreadsheet, you can use a line for each account, including the total balance and the total credit limit. Sum the balances for each account as well as the total credit limit for each account, and you'll have it there, right? Then you want to go ahead and divide your total debt by your total credit, as you can see done here in this example. So you'll have 3 different credit cards. One has a limit of $1,000, card 2 to $2,500, card 3 $1,500. That totals $5,000. So if these are your balances on your 3 cards, and you take that $970, as they're doing here, $970 is going to be divided by, right? I'm going to take that $970 and then divide that by the total credit lines, which gives you 0.194 as a credit utilization rate, which is basically 19%. All right, so that's very easy. We're just dividing the balance by the limit. How hard is that? All right, let's take a look at number 3. Your credit score increases when your ratio improves. So as your ratio goes down, as your debt ratio goes down, your credit score goes up. Of course, since your credit utilization rate plays such a large role in your credit score calculations, it should come as no surprise that improving your debt to credit ratio can improve your credit score. In fact, your debt to credit ratio is one of the only factors impacting your credit score that you yourself can influence in a matter of weeks. So you can pay your debts down, and once they report again, you can get increases in your score immediately. To the contrary, what I usually see with my clients is that they will have increases in on their credit cards and their revolving credit, and their scores will go down. So keep that in mind. Paying that, getting those ratios down, get your scores up. So we just have a couple more here. You can use a good ratio and still carry debt. So this does not mean you can't use your cards. You just have to make sure those rates are below 30%. All right, this is what they say is a good rule of thumb, is to keep your balances under 30%. I don't care much for that number because it's so easy to go over 30%. I think you should keep your balances around 20 to 25% on your revolving debt, and that will increase your debt ratio, usually increases your score. So I meant decreasing your debt ratio and increasing your score. Do you need a good ratio to get the best rates? All right, so there are some creditors that will not give you a loan or approve you for a credit card or revolving account if your ratios are high, like 50, 60, 70, 80, 90% will get you in trouble and get you declined for credit. Your credit utilization rate factors into around 30% of your credit score, as we talked about, which means almost 1/3 of your score is determined by how much debt you have versus how much credit you have. Okay, so in general, the lower your credit score, the higher the interest rates. Potential borrowers who have expended a large portion of their available credit often have higher potential for default, and they'll wind up being considered to be riskier borrowers. And as long as you're more risk, there's more risk involved with loaning you money, your rates are going to be higher, right? And so the last one is your debt to credit ratio and debt to income ratios are not the same. This is something I speak on quite a bit, for all its many names, including credit utilization rate and the balance to limit ratio. Your debt to credit ratio is fairly simple. It's a fairly simple number that has a big impact on your score. We talked about that. Let's just talk about the debt to income ratio. So your debt to income ratio, it factors in. It factors in on the things that you're trying to qualify for. But that's basically the amount of debt you have in comparison to your total monthly income. So that can change, right? With time as well. You can also reduce that to qualify for different items. So keep this in mind. I think this was a good article to just review some of the important factors of your debt to credit ratio. So these are 6 things you should know about a good debt to credit ratio. I hope you were able to learn something. Thanks for watching the video and getting more education on your credit, guys, and have a good one.